Let's talk a little bit about selecting multiples. And as I mentioned last week, the first tab in our model is a val sum tab. It's a valuation summary tab. We're going to summarize all of our analyses here. We're going to take the results from all three of our methodologies and show them here. The big question, though, is if you're looking at the solution, you'll see that now we've got some multiples that we've populated into this tab. The question is, how do we get those multiples? So that's what we're going to talk a little bit about today to start off the class. And I think one good way, another way of asking that question, a different way of asking that question rather, is to say, why do these companies vary so considerably in terms of how they're valued multiple-wise? In other words, why does General Mills trade at a multiple of 1.91 times revenues while ConAgra only trades at 0.85 times? That's a big spread. All right, that's more than a 2x variance there. So let's explore that difference. Let's also explore why these companies trade at different multiples of EBITDA. As we explain that, it's going to become more clear why we've selected the multiples we have in valuing our company A. All right, so what we're going to do is we're going to talk about a number of these different multiples. And what I want to do is for each different multiple, discuss some of the factors that cause those multiples to vary among companies. All right, and if we talk about all the multiples first, I'm going to talk about some factors that I like to call global factors that influence valuation multiples. All right, and these are factors that influence not just the total enterprise value to revenue multiple, but also total enterprise value to EBITDA, also price earnings, total enterprise value to EBIT, pretty much any valuation multiple we might have. These factors are going to play in all of those situations. All right, so who can think of, what are some characteristics of companies or different factors that might influence how they're valued? All right, we talked about it last week. What about the notion of growth? Remember we mentioned last week, Wall Street values growth. All right, so to the extent that all other things being equal, say we've got two companies, they're exactly equal in all respects, except one of these companies is growing more quickly than the other, well then that company is likely going to be valued more highly. It's going to have higher multiples of revenue, higher multiples of EBITDA, higher price earnings multiples associated with its valuation. All right, so again, all things being equal, Wall Street values growth, faster growing companies are valued more highly than slower ones. And that's part of the reason why we've captured on this comp sum tab some growth metrics. So we've looked at each company in terms of their revenue growth, latest 12 months revenues, as well as what we're expecting them to grow, the rate we're expecting them to grow at next year. EBITDA growth, earnings growth, et cetera. All right, very important in determining valuation. The markets look at this heavily. If you ever pick up an analyst report, you'll oftentimes see the analysts spending a lot of time talking about growth rates. All right, they influence all valuation multiples. All right, what else? What other characteristics? Yeah, question?
Leverage.
Leverage would impact our equity multiples. All right, so when we talk about a price earnings multiple, all right, leverage is going to really be at play, as we talked about last week. As I showed you in that leverage and tax shields example that I sent out to the class, leverage is going to affect the PE ratio. All right. In addition to the three global growth factors, we've talked about one, we're going to talk about two more. All right. But back to these global factors, what else might influence valuation? What about risk? All right. You've probably heard the term that Wall Street tends to be risk averse. All right. So if we've got a company, we've got, let's say, two companies. One company is growing its cash flows at a slow and steady rate. Year after year, they generate cash flow growth regardless of what the economy is doing, regardless of what other companies in its sector are doing. This tends to be, a less risky company than one that might be kind of all over the map in terms of their cash flows. All right. So if we take a look at risk, all other things being equal, again, I'm going to keep saying that over and over, if we can isolate just this factor, all other things being equal, Wall Street is going to place a higher value on a less risky company. All right, does that make sense? And that gets into required rates of return. We're going to talk about that a little bit more later today when we talk about weighted average cost of capital and how that relates to DCF. All right, but risk, growth, two of our three global factors. Anyone want to guess at the third? You guys are quiet this morning, so I'll just give this one to you. Size. All things being equal, larger companies tend to be valued more highly than smaller companies. And this is probably more at play when we're, not really comparing these companies. These are all pretty big companies already. If you look at their enterprise values, the smallest one is $10.2 billion. That's still a pretty big company, still pretty large. And in this case, we can see that maybe size does have an influence. All right, there are going to be some other factors, two that we've already talked about, and some others that influence why ConAgra trades at such a low rate. But size may be a small factor, small contributor to that as well. But that definitely comes into play when we're talking about comparing, say, Kraft, who has an enterprise value of $59 billion and revenues, I believe, of maybe $30 billion. If we compare that to a small private company, maybe an upstart company that has revenues of, say, maybe only $30 million and an enterprise value of maybe $40 or $50 million. Okay, so that's where size can have an impact as well. So again, all things being equal, companies that are bigger tend to be valued more highly. Companies that are less risky or more stable in terms of their cash flow generation track record tend to be more highly valued, and companies that are growing faster. All right, so again, those affect all different multiples. Let's talk now, though, a little more specifically about, say, a total enterprise value to revenue multiple. Enterprise value to revenue multiple, again, getting back to the question, why is General Mills trading at 1.9 times revenues, ConAgra trading at only 0.85x? What might be a key factor in determining that difference in terms of the total enterprise value to revenue multiple? There's really only one that I'm looking for, one specific factor. Anybody know what it is? What about profits, profitability? That is, for every dollar of revenue generated by, say, General Mills, the market is going to expect General Mills to generate more profitability on a relative basis than ConAgra. Right? And we can see this played out in their margins. So if we look, and this is why we're capturing these margin data down here in the bottom of this table, is to provide for more comparison between these companies. And if you take a look at these revenue multiples, and then you contrast those with profit margins, you'll see that ConAgra, being the least profitable company of the five, pretty much across the board in terms of their EBIT margins, their EBITDA margins, and their net margins, well, then it starts to make a lot more sense why they're valued so lowly in terms of their total enterprise value to revenue multiple. For every dollar of revenue ConAgra generates, they're going to send less to the bottom line than any of these other companies. They're going to retain less at the EBIT or the EBITDA level than every other one of those companies. Make sense? And it's not a perfectly linear relationship. That is, if you line these five companies up in terms of their profitability, the revenue multiples won't track exactly, but there's a pretty strong correlation. All right, so if we take a look at a company like Kraft, Kraft is the valued kind of next highest in terms of their revenue multiple, and they're pretty much the next highest in terms of profitability. Their EBIT margin is 12.5%, their EBITDA margin is 14.8%, their net margin is 6.7%. Right, so they're valued at this using the second highest multiple of revenues, right, then kind of on up from there. General Mills doesn't tend to be, they're not the absolute most highly profitable company of the three, but they're pretty close. Okay, they're pretty close in terms of their EBIT, especially their EBITDA margin, they're right up near the top. Their net margin, they're right up near the top as well. All right, so it doesn't hold perfectly. Again, some other factors are probably at play here as well. But when you start looking at these different metrics, growth metrics, profitability metrics, size, risk, et cetera, we start to make a lot more sense about why certain companies are valued more highly than others. Does that make sense so far? All right, so we've talked about these global factors. These affect all of our multiples. We've talked about the total enterprise value to revenue multiple, primarily affected by profitability in addition to these three. Let's talk a little bit about the TEV to EBITDA multiple. All right, again, what is EBITDA? I mean, it's earnings before interest, taxes, depreciation, and amortization, but why do we use it? What's it a proxy for? Proxy for cash flow, right. Right, it's a proxy for of the company's earnings, of its operating earnings, and how much of that actually is going to translate into cash flows. And if you think kind of through the cash flow statement, cash from operations section, we start out with net income, we add back our non-cash, we take into account some of our working capital changes, and get to our cash from operations. If we think in terms of free cash flow, which we'll talk about a lot more when we talk about DCF today, we're going to talk about EBIT, we're going to take out taxes, we're going to take out CapEx, we're going to add or subtract our working capital changes, we're going to add back D&A. All right, if you think in terms of those factors, it becomes pretty easy to explain why companies vary in terms of their EBIT, or in terms of their EBITDA multiples. All right, and the first factor is CapEx. And when I say CapEx, I mean how well is each company, or how poorly in some cases, is each company managing its CapEx cycle? Are they reinvesting in the business? Are they spending enough on CapEx so that they can achieve their growth projections going forward? When it comes crunch time, when a company maybe starts to run a little short on cash, they dial back on a lot of different things. They cut back on hiring, they cut costs across the board, maybe they start skimping on CapEx as well. And just like the example I gave last week, if we have a car, but we never change the oil, eventually we're going to have trouble with that fixed asset. Same thing goes with a company. If they've got machinery and equipment, they never maintain it, they never upgrade it, eventually they're going to have to spend a lot of money down the road, spend a lot of cash to catch up. So when we take a look at the EBITDA multiple, again, EBITDA being a proxy for cash flow, CapEx being a key component of our cash flow calculation, company's CapEx spending relative to its revenues is going to be pretty important. Okay, and this one's a little tough to see playing out right here. We're only capturing LTM CapEx as a percentage of revenue. Probably want to go back and look at that historically and compare each company to the overall industry. And analysts tend to do that, you know, in more detail in their analyst reports. They'll talk more about capital spending in some cases. Again, all of these factors, I would use the caveat, all other things being equal. If we can look at these items in isolation, then we can get a sense for why they are valued differently. So another item that can cause variability between companies' total enterprise value to EBITDA multiples, working capital. How well or how poorly does a company manage its working capital? That is, does it collect its receivables more quickly than its competitors? Does it turn its inventory more quickly than its competitors? Is it able to stretch its payables longer than its competitors? Okay, remember we talked about this a little bit last week. We're going to spend a lot of time, we're going to spend some time talking about it today, a lot of time talking about it tomorrow. But the more quickly a company can turn over its working capital assets, the more cash it's generating. The more cash it's generating sooner, that drives value, especially in a DCF model, as we'll see later. All right, so companies that collect their receivables more slowly, maybe they've got some obsolete inventory, they can't turn it over as quickly, that ends up being a use of cash. It ties up a company's cash flows. Does that make sense? So again, all other things being equal, companies that manage their working capital cycle more effectively tend to be valued at a higher multiple of EBITDA than others. Also not something we can really see played out based on the metrics we've captured and summarized, but analysts take a look at this as well. We can capture receivable turnover, we can capture inventory turnover, we can calculate those pretty readily if we want to. And then the last item, management. How strong or how weak of a management team does each company have relative to its peers? All right? And all things being equal, what would you think? Do you think a company with a better management team should be valued more or less highly than a competitor with an equally or with a worse management team. Again, all other things being equal. The key is thinking through how I phrase the question. All other things being equal, if we've got a better management team in one company and a worse management team in the other, all things being equal, they're generating the same cash flows. This worse management team, this company over here is doing it with a worse management team. So there's room for improvement. And that's kind of the theory there. Makes a little sense when you explain it, but almost kind of counterintuitive the first time you hear it. All right? So these are basically the factors that are going to affect our multiples. Right? And the key here is, again, all other things being equal. If you've got two identical companies and you can look at these items in isolation, it's going to have a big difference in terms of how well or how highly or how lowly a company's valued. Any questions on that so far? Let's apply this in more of a practical sense to our own company. All right, and again, the goal of this valuation exercise is to value our hypothetical company A, a food processing company. So again, where the rubber meets the road, so to speak, is we've got to pick some valuation multiples based on our comps, apply those to the operating metrics of company A to arrive at some indications or implied ranges of value on a total enterprise value basis. So the first thing we're going to do here, again, we're working in our comparable public companies analysis. This will give us the value of company A on a minority interest basis, as we talked about before. And we're going to apply 3 different multiples to the company's revenues, both this year, last year, and next year, EBITDA, and price earnings. All right, so for the total enterprise value to revenue multiple, this representative level, as I talked about last week, this is what this hypothetical company did on an LTM basis. All right, I made it up. It's not a real company, but we're assuming company A did $195 million of revenues last 12 months. Next year, we expect them to do 205. They did $33.2 million of EBITDA last year. We're expecting them to do 36.9 next year. And then 16.6 bottom line last year, 18.5 million next year. But the key is, how do we select these multiples? On a revenue and an LTM revenue basis, we've selected multiples ranging from 1.6 to 1.7 times. That is, we think that the company is going to be valued somewhere between 1.6 and 1.7 times revenues. It's very rare, especially if we're early in the process of talking to a prospective client, that we're going to go in and say, you're going to be valued exactly at this number. We oftentimes, as bankers, speak in terms of ranges until we get enough information where we can really pinpoint that valuation number. All right. So all of these are expressed in the form of a range, both in terms of the multiples and the total enterprise value. Let's take a look at those multiples ranges and figure out how we selected those. So if I go to my comp sum tab, I go back there again. Remember, I selected a range of 1.6 to 1.7 times. That tends to be toward the upper end of the range indicated by our comps. Not the highest. Again, General Mills is trading at 1.9 times. We've assumed 1.6 to 1.7. The way we've done that, just like we talked about up here, I took a look at our hypothetical company's profit margins. Based on those profit margins, I selected multiples of companies that have similar levels of profitability. All right. So what I did, I apologize for the toggling back and forth, it is kind of necessary. If we look at our EBITDA, latest 12 months EBITDA is $33.2 million. It's a profit margin, an EBITDA margin of 17%, which if we look at our comps, we go down to our EBITDA margins, 17% tends to be toward the higher end of the range. It's not the highest, but it's toward the higher end of the range. On a next year basis, our EBITDA margin is 18%, also toward the top of the range, but not the highest. Okay, so I did an analysis of profitability, and I'm taking, at the end of the day, and it does become somewhat of a subjective analysis here. You're not typically going to be able to pinpoint or run a regression. It's going to give you an exact number. but I've subjectively selected ranges of multiples that tend to be toward the higher end of our comps range. If we apply those, it gives us a valuation range of 312 to 331.5 on an LTM basis, 308 to 328 on a next year basis, based off of next year's revenues. All right, so that's the total enterprise value to revenue multiple. On the EBITDA multiples, all right, this is a little more difficult in this case because Company A is a made-up company. I can't really go back and analyze how well or how poorly they've managed their working capital because I made them up. I don't have historical data. I don't have necessarily historical data on how well they manage their CapEx program, and I don't know who their management team is because they don't exist. All right, so in this case, I've selected multiples, EBITDA multiples, that pretty much approximate what's indicated by our comps. In other words, our comps trade from 8 to 11.2x on a last 12 months basis, 7 to 10x on a next year basis. I've chosen multiples of 9 to 10 times LTM EBITDA and 8 to 9 times next year's EBITDA. And if I multiply those out, I'm getting ranges of value anywhere from 295.2 all the way up to 332.1. Pretty similar range to what I got using my revenue multiples. And then on the PE multiple, I've done kind of a similar exercise. I've selected multiples that approximate the range indicated by our comps, 13 to 17 times on an LTM basis, 12 to 16 times on a next year basis. The only difference between the price earnings and the total enterprise value, the TEV multiples, again, these are equity multiples. So if I multiply an equity multiple by earnings, it's going to give me market value of equity, not total enterprise value. Right? So that's why we multiply these together, we get market value of equity, we add our debt, we subtract our cash using that total enterprise value formula we went over last week to get to enterprise value. Okay, so you can use a PE multiple to get to enterprise value. You must take these interim steps, though. Does that make sense to everyone? And if we multiply these out, we add debt, we subtract cash, we get ranges anywhere from 261 to 335. Again, pretty similar to what we've seen based on our other multiples. And again, these are on a minority interest basis. So if we're valuing this company for, say, an IPO, we're going to be selling some minority interest in the company as part of our engagement with the company, then this is probably a really good way to go, looking at comparable companies. If we're looking at the company, we're trying to sell the whole company, we would probably want to take these and add some control premium to it to reflect the fact that we'd be selling 100%, we'd be selling a controlling interest. And we'll talk more about that in a minute. All right, well, we also spread a couple precedent transactions. We finished our precedent transactions approach, so now we've got multiples that we can apply in this regard. If we go back to our homework, if we go to the precedent transactions tab, we scroll down here, we can see that our mean and median, or our median and mean, enterprise value to revenue multiples, 2.7 and 2.72 times. EBITDA multiples, 14.3, 14.5. Pretty much approximate what we've chosen in here. And many of the same rules apply. If we're looking at precedent transactions and we're looking at a total enterprise value to revenue approach, ideally what we want to find are target companies that when they were sold had similar levels of profitability to our company. So if we remember back to that, EBITDA margin was 17%. If we look at our precedent transactions, we'll see EBITDA margin 17%, sort of in the middle of what's indicated by our comps, maybe just a little lower. And so we've selected 2 to 2.5 times revenues as our multiple, where the median and the mean were a little bit higher than that. Okay, so we've taken into account profitability here. On the EBITDA side, again, company is a made-up company. It's a little hard to analyze how well they manage their working capital, et cetera. So 12 to 14 times multiple, a little bit lower than the median, the mean, but still approximating what was paid in comparable transactions. So once we have those multiples, again, the exercise is simple. We multiply them out, giving us a range of 390 to about 488 million. You'll notice this is a good bit higher than the ranges that we saw in our comparable public companies approach, mainly because of that control premium. That will explain the difference in this case. And if we look at our precedent transactions, we see that median control premium was about 16%. The mean was about 15.5%. So that explains that variation in value between our two approaches. And again, if we're pitching to this company A, we're trying to win their business as their M&A banker, we're going to sell them on a controlling interest basis. This precedent transactions approach is probably going to be the best way for us to figure out what valuation should be, because it's already on a controlling basis. If we wanted to, again, if we wanted to convert our comparable public companies approach to a controlling basis, we could multiply these by 1 plus the control premiums that were indicated in our precedent transactions. We're not done with valuation, all right? You'll see that we still have to populate our numbers for our DCF. That's going to come once you're done with your homework. So when you finish your homework, there'll be a low, there'll be a high in your DCF model. Those will get populated right here. Once we have a full data set, then we can start drawing some conclusions. But we're 2/3 of the way there. We've done precedent transactions, we've done comps. All right, so we talked about some of the characteristics that go into selecting multiples. Maybe I put the cart a little before the horse. Typically what we're going to do before we select our multiples is we're going to analyze our data set. That is, if we've got 10 different multiples and they range from, let's say, 1 to 5, 1 times revenues to 5 times revenues, we're going to want to take a look at how that data set is structured. Maybe there's one that's on the very low side. Maybe most of them are clustered between 2 and 2.5. You've got a really low outlier and you've got a really high outlier. In those cases, you would want to understand why those exist, but in many cases, you might eliminate them. You might drop an outlier on the low side, you might drop an outlier on the high side, and then calculate a median, or then calculate a mean, or look at the rest of your data set. Maybe you might calculate an upper quartile, lower quartile, you might do deciles, do some other statistical approaches. But it's really going to depend on what the data set looks like, what the raw data look like, to determine how we're going to adjust for some of those factors. So you might eliminate outliers. As we did, we took a simple average, we took a simple median of our whole data set. You could do a total average, you could do a stripped average. I sort of gave an example of a stripped average below, or a moment ago. Take out the high, take out the low, average the rest of them. So that might be a stripped average. And then again, upper and lower quartiles. Most of the data in our model were I didn't see really any outliers. There was a pretty normal data set from what I could gather. But again, if most of the companies are valued between 1 and 1.5 times revenue, and there's one that's 3 times revenue, we'd want to at least understand it and figure out whether it was an outlier and we needed to take it out of our data set. When we look at companies, we want to rate those in terms of their risk. We kind of talked about this: risk, their growth, their profitability, et cetera. Obviously, comparable public companies approach, precedent transactions approach, we want to find companies that are as comparable to our subject company as possible. And again, when we're investment bankers, we're typically speaking in terms of ranges of valuation. We're not often going in, actually you'll pretty much never see going in on the early side of an engagement and saying this is the number and that's it. We're going to speak in terms of a range until we know more information. And as I touched on last week, there's also the notion of public versus private values. We're valuing public companies as part of our comparable public companies approach. The stocks of those companies are pretty liquid. Anyone who owns shares of stock in Kraft or ConAgra or General Mills, if they wanted to sell that, it's a pretty straightforward and quick exercise. They call their broker, they go onto E-Trade and sell the shares, and they can get pretty much instant liquidity. Well, if we're valuing a private company, if company A is private and we own shares in that company, that's going to be a very different process when we go to unload those shares. It's probably going to be time consuming, it's going to be costly, we're going to have to hire someone generally to sell those shares. And the buyer, because of that lack of liquidity, is probably going to demand some type of a discount. Right? So if you're valuing a public versus a private company, you need to be mindful that private companies typically have a lack of marketability associated with them. There are a lot of academic studies that talk about what those discounts can be, generally 25 to 45%, but I've seen them all over the map. I've seen them as high as 70%, I've seen them as low as 5%. It really depends on the situation. But generally speaking, I think 25 to 45% is a typical range of liquidity discounts you'll see. You can also sometimes, and I valued a public company once where we had to do a liquidity discount because they were so thinly traded. And because a lot of their shares, big blocks of their shares were controlled by just a few people. So if somebody came in and got a small position, it might still take them a while to sell those shares even though they're public companies. There might be very minimal research coverage, there might be a thin float, or not much of a float, they don't trade very often, that type of thing. And again, these come with a little bit of experience in just seeing situations and getting used to taking them into account, but be mindful, especially valuing public versus private companies. All right, so again, let's talk about the third of our three valuation methodologies. Again, discounted cash flow analysis. The first two valuation methodologies were what we call relative valuation methodologies, in that they're based on the application of multiples. DCF, on the other hand, is what we would call an intrinsic valuation methodology. We're really looking at the company on a standalone basis for the most part. And a lot of folks might refer to it as the income approach. You'll hear that a lot of times, especially real estate appraisers will refer to this as the income approach, but it's basically a discounted cash flow analysis. Right, who's done a DCF? Okay, I would imagine a good number of people. Anybody who's taken a finance class has probably been at least exposed to DCF. All right, but in the real world, as we talked about before, as long as we have enough data to do a precedent transactions approach, comparable companies approach, those tend to be a little more heavily relied upon than DCF. They're a lot more, I think they provide a more real-world example, and as we'll see a little bit later, DCF can have a lot of sensitivity to the types of inputs that we might put into the model. And some of the inputs that go into the model are questionable in terms of their validity. We'll also talk about that a little bit later. All right, but basically a DCF, what it does, we're forecasting the free cash flows of a company into the future. We're discounting those back to the present and expressing them in present value terms. What is the value today of cash flows we expect to receive in the future? And in that process, in that discounting process, we're taking into account what would an investor's required rate of return need to be to invest capital into that business. Right? When we get to the weighted average cost of capital, we'll talk a lot about that. But that's basically what a DCF is. And if you break it down into 4 concrete steps, we've got what we've listed up here. Obviously, if we're going to discount forecasted free cash flows back to the present, we need to first have forecasts. So that's the first step in our model is, number 1, identifying components of free cash flow. We're going to show you what those are in a minute. All right, we're going to build, oftentimes we're going to build our own projections. Sometimes the management of the company will give us projections, in which case it saves us a little bit of time. We might build our own projections using some assumptions. That's an exercise we'll do tomorrow. So if you're in a situation where the company doesn't provide them, you'll know how to build them yourselves. And we'll build these again using assumptions, and typically we want to keep in mind historical figures when we do that. That is, if a company has grown 3, 4, 5% a year over the last 20 years, it's probably going to be hard to justify using a 20% growth rate, right, absent evidence that would support that. Also need to decide how many years we want to forecast. Typically in banking, private equity, we'll do probably like a 5-year DCF. That is, we'll forecast the company's results for the next 5 years, right, and then we'll make an estimate of what its value will be at the end of that period. We're going to talk about that in a minute. Okay, sometimes in commercial real estate, you'll see a 10-year DCF. It's a little easier to forecast in commercial real estate because a lot of times you have leases, you've got contractual obligations telling you what your revenues are going to be. All right, but that's the first step, forecasting our cash flows. The next step, as I mentioned earlier, we have to discount those back to the present. So we need a discount rate. In our model, it's going to be known as a weighted average cost of capital, often referred to as a WACC. We're going to go through a whole analysis on how we calculate a weighted average cost of capital later today. Right, but it's basically a blend of required rates of return of the debt investors and the equity investors of the company. We blend that based on their contributions in the capital structure. And the cost of equity is typically estimated using something called the capital asset pricing model, CAPM. We're going to go through that as well. All right, so we forecast our cash flows. We need to know what our discount rate is. Third step is we need to figure out what is something that we call the terminal value. Exactly. We're assuming, we're doing a 5-year forecast, but we're not assuming the company goes away after 5 years. Right? Unless we're evaluating some finite 5-year project that we do expect to end after 5 years, the company is going to have value from year 6 into infinity. And that terminal value will estimate that value at the end of our 5-year forecast model. So in other words, at the end of 5 years, we're going to say, what is the present value at the end of year 5 for the cash flows from year 6 into infinity? That's our terminal multiple approach. Couple different ways to calculate that, either using an EBITDA multiple on year 5 EBITDA, or maybe doing something called a Gordon growth approach. We'll talk about both of those a little bit later. But at any rate, we're figuring out the value from year 6 to infinity, and then we discount that back to present value as well. So at the end of the day, we're going to forecast cash flows for 5 years, discount those back to the present. We're going to forecast the terminal value, year 6 to infinity. That'll be expressed at time 5. We'll also discount that back to time 0. And at that point, it's really just a matter of adding them up. What's the present value of our cash flows from year 1 to 5? What's the present value of our terminal value? We add those together. That is the present value, the total enterprise value of the company at time 0. Pretty theoretical model. There's a lot of theory in today's lecture. Probably one of the tougher lectures to give from my standpoint. A lot of times for students, one of the more theoretical lectures to listen to. All right, but we'll go through these in detail today. I've also put together a weighted average cost of capital instructions page. It's in Excel. It's a 14-step, step-by-step approach to doing a weighted average cost of capital. So you'll have that as a takeaway. Right? The slides walk through DCF in good detail as well. We're going to do some in-class exercises. You're going to do some homework and give you a really good idea of how we do this. All right, so pros and cons of DCF. All right, in many ways, DCF is more flexible, or in some ways, it's more flexible than the other two methodologies. We're not relying on a lot of public company information. All right, so this, if we don't have a lot of good comps, say we're looking at a company that's just in a real niche industry, there's just no one out there, no public companies out there that do what they do. And if there haven't been any transactions involving the purchase of similar companies, then DCF is probably all we're going to have to rely on. And we're going to have, again, in many cases, a more flexible model that's not reliant on a lot of public information. Some people call it an objective framework. In some cases I agree with that, in others I don't. But in many cases in investment banking, I mentioned earlier, if you've got enough data to do a comps analysis, if you've got enough to do a precedent transactions approach, a lot of times DCF will take a back seat to those. We'll rely on comps, we'll rely on precedent transactions, and we'll use DCF really to support the conclusions we've drawn from the other two analyses. All right. The reasons why DCF is oftentimes looked at as not being the best approach to valuing companies. It can be, like I said before, very sensitive to small changes in some of the inputs. All right, and we'll see that as we go. We'll see that as we change the discount rate a little bit, or as we change maybe a terminal value multiple a little bit, it can have a major impact on the overall value that's indicated by a DCF. All right. Terminal value usually comprises a large portion of the overall valuation, which in many ways makes sense. All right, years 6 through infinity is a lot longer time frame than just the first 5 years of our model. But years 6 through infinity also reside way out in the future. And so we're relying on results way out in the future to deliver value today. All All right, cost of capital depends on something called beta, depends on something else called market risk premium. We're going to talk about those when we talk about the capital asset pricing model. Those are two pretty theoretical inputs that have been shown to be a little bit questionable in terms of their validity, in terms of their accuracy in predicting stock returns. So let's talk about free cash flow. We mentioned it before. Let's define exactly what it is. So our free cash flow is going to be calculated by taking our EBIT less, less taxes. Okay, because as we said last week, as everybody knows, we've got to pay Uncle Sam. We've got to pay our taxes. We also are going to take out CapEx because the company needs to reinvest in its business, needs to invest in capacity to be able to generate future returns. We're going to add or subtract our changes in net working capital. All right, remember, working capital can be a source of cash, it can be a use of cash. And in some cases, it can be a very, very big use of cash, especially when companies are growing. I think I talked about the term companies growing broke. I think I mentioned it last week, but as a company's growing, it has to invest a lot of money in many cases in its working capital. It's got a lot of cash tied up in inventory and receivables, and unless it can collect those items quickly, it can go broke even though it's growing at a very fast rate, even though a lot of signs of the business would otherwise indicate that the company's very healthy. All right, and then the last item what we need to do is we need to add back depreciation and amortization. Not because they're a source of cash, but again, they're non-cash items in our income statement. Same reason that we add it back when we calculate EBITDA, we add it back here. They're non-cash items. Okay, so when we add all these up, it gives us a company's free cash flow. And you'll notice, based on how we've set up this equation, free cash flow is something that's unlevered. It's before we consider debt. We talk about earnings before interest, okay, and nowhere in here are we taking into account payments to the debt holders. We're not taking into account interest payments here. All right, so free cash flow is an unlevered item, therefore it's when we add it up or when we discount all those free cash flows back to the present, our result will be total enterprise value, the value to all providers of capital of the company. Now we can use this, we can still calculate the value of equity, right? But we've got to, once we get total enterprise value, we've got to take out debt, we've got to add back cash, etc. Basically reverse that total enterprise value formula, solve for market value of equity. So we can use it to get there. But the way we've set it up here is unlevered. When it spits out a value, that value will be total enterprise value. We talked about this before. Again, DCF, usually 5 years plus a terminal value. The terminal value we talked about, again, this is the value of the investment at the end of the period, the value of the company from year 6 through infinity. All right, no surprise there. But let's talk about how we calculate that. Typically, it's calculated one of two ways. If you took a finance class in college or in business school, you probably learned that you do this using a Gordon growth model, also known as a perpetuity model, basically growing year 5 cash flow at a constant rate into infinity, and then discounting it back to the present. Right? The other way of doing this, and this is the way that Wall Street, this is the way most investment bankers, most private equity firms calculate this, is to use a multiple-based approach. That is, take a look at what was the company's year 5 EBITDA in most cases, multiply that by a representative EBITDA multiple, and that would be the value of the company at the end of year 5. Similar to using an EBITDA multiple based on LTM results at time 0, as we do in our comps and as we do in our precedent transactions approach, here we're just using it at the end of year 5. And a lot of times what we'll do, we're doing DCF in addition to a comps approach, in addition to a precedent transactions approach. So we'll probably have some good ideas of how the industry is being valued on an EBITDA multiple basis. A lot of times what we'll do is we'll say the industry is trading at, say, 9 times EBITDA today. We're going to assume the industry will still value companies in this industry at 9 times 5 years from now. All right, and sometimes, maybe it's not an EBITDA multiple, maybe it's a revenue multiple, maybe it's an EBIT multiple, maybe it's an equity multiple, who knows? All right, you would apply that multiple to the respective operating metric of the company. Okay, Gordon Growth formula, again, Gordon Growth is exactly what terminal value states. It's a perpetuity value. And that terminal value, there's the formula right there. We take year 5 cash flow, we multiply it by 1 plus the growth rate, and then we divide it by K minus G, or the cost of equity minus our growth rate. Perpetuity value. Let's talk a little bit about cost of capital and our discounting mechanism. All right, let's first talk about the discounting mechanism. So I want to make sure everybody understands what I mean when I say we're going to discount something back to the present. All right, how many people have heard of the time value of money? Most. Good. All right. Time value of money basically states that we would value something, if something's going to be worth, say, 100 a few years from now, we're probably going to pay somewhat less for it today to compensate us for the risk and to give us a return that meets our return requirement over that period of time. A simple example is if I walk into a bank and I say I want to buy a 1-year CD, I've got $100, what can you offer me? All right, the banker's probably going to say I can offer you, 2% or probably even less than that these days with interest rates the way they are. But let's assume they give me an interest rate of 2%. That would mean that at the end of 1 year, when I cash in my 1-year CD, my $100 will then be worth 102. Another way of saying this is we take the present value, we multiply that by 1 plus our return, required rate of return, in the case of a DCF. We raise that to the nth power for the number of periods that that's going to be compounding. In our model, in my simple example, that was just 1. But sometimes that might compound over many years, 5, 10 years, whatever it is. And if we multiply those terms, it gives us the value at that time in the future. Okay, if this is a 5-year CD, I would have raised 1 plus my rate, 1.02 to the 5th power, probably got something around 115 or so with compounding. In our DCF model, what we're actually doing is just if we make an algebraic adjustment here, we know for each year what our future value is going to be. For each year, again, we're discounting free cash flows. Right? Free cash flow at time n. If we do a little bit of algebra here, we're trying to solve for present value. If we divide that by 1 plus our rate raised to the nth power, it gives us present value. And that's basically the equation we're going to use over and over and over within a DCF. If you understand time value of money, you understand how to discount the way I've just showed you, a DCF mechanically is pretty straightforward. So when we set up our DCF, we're going to do this for every year. So free cash flow in year 1 divided by 1 plus r to the nth to the 1st power, plus free cash flow year 2 divided by 1 plus r squared, and so forth. That's our DCF, pretty much, from a mechanical standpoint. All right, and then at the end of the year, we'll also discount that terminal value back to present value, add it to all of our results to get a DCF. Now the cost of capital in this model is basically going to be what is the required rate of return, what is the rate of return that investors are going to require in order to put capital into this business. Usually comprised by 2 different forms, rate of return on debt, rate of return on equity. All right. So what do lenders require in order to loan the company money? What do equity investors require to put money in as equity? And as we talked about in the very beginning of class 1, the higher the risk, the higher the return. Equity investors generally in the highest risk position, so they're going to have a higher return requirement than, say, a senior secured lender. It's going to take a lien on assets, going to have first priority of payment, they're going to get their interest before anything is available to the equity holders, etc. All right, and we've noted here that the cost of capital needs to match the cash flows to be discounted. Again, our model, okay, if we're discounting free cash flows, we're discounting by the weighted average cost of capital. It's a debt-free or it's an unlevered model. You can also do this on a levered basis. It's called a flows to equity approach. In this case, or in that case, you'd be discounting, instead of free cash flow, you'd be discounting the cash flows that are available to the equity holders after debt's been paid. and you discount that by the required rate of return on equity. So you can do this a couple different ways. Typically in banking, we're trying to solve for enterprise value, so we use a debt-free model. So we talked about this a little bit already. The discount rate is expressed in two forms: cost of equity, cost of debt. The one thing I'll point out here is if the company has preferred stock, we're going to want to include that in the equation as well. We want to take into account the cost of that preferred stock and the relative weighting of preferred stock in the capital structure. Again, the weighted average cost of capital is a weighted average of the cost of debt, weighted average of the cost of equity. We're basically calculating it here. The formula is pretty straightforward. The one thing that I'll point out is with respect to the cost of debt, we'll take it another step and we'll multiply it by 1 minus the tax rate. Who can tell us why? Tax shields. Interest is tax deductible. All right, so for every dollar of interest, the company is reducing its pre-tax earnings by $1, therefore reducing its tax burden as well. All right, it's just like if you own a home, that mortgage interest is tax deductible. Interest is tax deductible from a company standpoint, so there's value to those tax shields. And that's why we multiply by 1 minus the tax rate. But otherwise, it's a very straightforward approach. Our cost of equity times the relative proportion of equity to the total capital structure plus cost of debt times the relative proportion of debt to the total capital structure, again, times 1 minus the tax rate. And it's expressed in percentage terms. You'll see weighted average cost of capital ranging all over the board, depending on what type of company you're talking about. In our example a little bit later, these companies have a weighted average cost of capital, a WACC of probably around 6, 7, 8%. Mature, low-growth companies tend not to be that risky in terms of their cash flows, so they have lower WACCs. When dealing with other types of companies, though, especially maybe very small companies, maybe a company that has a very key person involved in their operations, there's also some opportunities, and we'll show you this later, to encompass or to capture what we call company-specific risk and account for that in our model. The way we do that is basically we increase our required rates of return, we increase our WACC, and there are a number of different reasons why we might do that. As I mentioned earlier, companies that are much smaller tend to be valued, tend to have a little more risk associated with them than a company like Kraft with enterprise value of, say, 60 billion, 30, 40 billion dollars a year in revenue. Okay, you might also see, and you see this a lot in early stage companies, or business model or projection risks. A lot of times with early stage companies, you'll see what we like to call hockey stick projections. That is, maybe the first couple years revenue's ticking along and then it just goes like this, off the charts. All right. Well, if one little thing doesn't happen at the right time, then revenues may not grow that way. There may be a lot of risks specific to the company's ability to achieve their projections that are so aggressive. Again, I'll show you how we encompass that in the context of a weighted average cost of capital a little bit later. Let's talk a little more now. Let's talk specifically about the cost of equity. And I mentioned it earlier. Cost of equity is calculated using something called the capital asset pricing model. I know it's up on the screen. I'm going to put it up on the board because we'll refer back to it a little bit more going forward. But the capital asset pricing model basically says that a company's cost of equity is going to be equal to the risk-free rate. I'm going to define each of these terms in a moment, plus beta, again, I'll define it in a moment, multiplied by something we call the market risk premium. Who's seen this before? Good, most of you have. All right. Risk-free rate, what do I mean when I say a risk-free rate? Return on a government security. Government securities, they're backed by the quote-unquote full faith and credit of the United States. If they needed to, they could print more money or they could raise taxes to ultimately pay the interest or the principal on those bonds. So a lot of times, most cases we'll use, say, a 20-year treasury, 20-year U.S. Treasury bond rate, something that you can look up any day that you need to. Going back, I think, all the way to 1955. You can go to the Federal Reserve website, look up what the Treasury rate is on any given day in history. All right, let's talk about market risk premium. What do we mean when we talk about market risk premium or equity risk premium? It's the premium that an investor would expect to get over and above the risk-free rate by taking the risks associated with investing in equities. This RM figure notation relates to what is the return on the market, usually the S&P 500 or the NYSE index or some market index, basically saying if the market returns 7% over time and you can get 2% in a risk-free rate, that market risk premium or that equity risk premium would be equal to the difference, or in this case, 5%. So the last item, what's beta? Beta is a measure of risk. It's a measure of volatility. Right? And what we call beta is a measure of what we call systematic risk. That is, how much would a company's stock price, its equity value, rise and fall given a, beta, or in conjunction or in correlation with a given change in the market. So if the S&P 500 goes up 1%, what would we expect a company's stock to do? If it goes down 1%, what would we expect the company's stock to do? A beta of 1 means we would expect an exact mimicking of what the market is doing or has done. All right, -1 would be a perfectly negative correlation, so it would move opposite of the market. All right, so this is a measure of risk, beta, a measure of systematic risk. Typically, you'll find betas ranging, I'd say 0.5 to 1.5. Anything below or above that. Here I know the slides say above 2.5, but you don't really see a lot of betas up that high for public companies. The interesting thing about all three of these items is we're not calculating them, we're looking them up. These are items that we can find that are pretty readily available to us if we work in an investment bank, or even if we don't. Again, we can go to the Fed website and get our treasury rate. You can go to a number of different data feeds, whether it's Bloomberg or different sites to get a company beta, usually a 2 or a 5-year beta, that is looking back either 2 or 5 years, measuring daily changes in a stock price, correlating that with daily changes in the market returns. And we typically can look this up, the market risk premium, typically we can look this up from a source called Ibbotson. Ibbotson Associates publishes, I think it's a quarterly, I think it's stocks, bonds, bills, and inflation quarterly. They will give you short, long, medium-term market risk premium data. Pretty easy to find. So when we talk about the drawbacks in the DCF approach, most of those drawbacks are actually specific to CAPM. And more specifically, we're talking about drawbacks as they relate to beta and the market risk premium. These are both items that have been calculated on a historical basis. In the case of beta, a lot of times you'll see going back 5 years. So every day for the last 5 years, what has that stock price done relative to the index? Market risk premium, you can calculate that going back as far or as short in duration as you want to. You can go back 80, 90 years, you can go back 10, you can go back 30, you can go back 5 years, and a lot of times those vary quite a bit. Think of the volatility we've experienced in the last year in the markets, in the equity markets. Valuations have been all over the board. In a lot of cases, these market risk premiums, if you go back, say a year, and now the market's had kind of a run up, but if you were sitting back at, say, December of last year, after all of the drop in valuations, and you went back only a year or two, you might actually see a negative market risk premium. So there was a negative premium associated with holding equities as opposed to holding risk-free securities. Right? And these are historical measures. They are not predictors of future returns. Right? Just because a company's beta, and Jeff mentioned the example of GM, might have had a beta of 1 at one point, well, we've seen what's happened since then. So it doesn't necessarily hold for the future that betas are going to be predictors of stock price returns, and market risk premiums can change based on volatilities as well, and they can vary considerably depending on the period you're analyzing. Right? So if you get asked in interviews, what are the drawbacks of DCF? Why isn't DCF used as often as these other methodologies? Those could be 2 good answers to give. Now, specific to Arvis's question, what if we're looking at a private company? Right? Private companies don't have publicly traded equities, so we can't look up their beta. And this is exactly the question we're going to be dealing with when we get into our model. Our company A, our hypothetical company, does not have public equity. We need to figure out what is the beta. What would be a relevant beta to use for that company? So what we do is we actually take a look at our public companies from our comps, Kraft, Conagra, those same companies we've been looking at. We look up their betas, and then we do something called unlevering those betas. Remember, beta relates to stock prices. It's calculated based on movements in stock prices, and as we talked about last week, stock prices, stock equity valuations, equity multiples can be affected by leverage. So to the extent that our 5 companies are using different amounts of leverage, their equity prices are going to be affected in different ways. If we want to remove that effect of leverage, we can do what we call unlevering their betas. And when we do that, it gets us down to something called an unlevered beta, or also known as an asset beta. What would the beta of that company be if it had no leverage? The formula we use, very simple. I mean, it's just basic. It's a basic calculation. If we want to unlever a beta, we take its levered beta, we divide it by 1 plus the debt to equity ratio times 1 minus the tax rate. Debt to equity ratio is basically how much debt relative to equity is that company using in its capital structure. How much leverage is it using? So we're taking into account its leverage when we're unlevering. And then what we do for our subject company is we choose some unlevered beta. Sometimes it's the mean or the median unlevered beta of our comps. And we re-lever it with an assumption of what our subject company's capital structure could or should be. What is its optimal capital structure? What is its optimal mix of debt to equity? All right, and that's where it really gets a little murky in terms of choosing that. Sometimes we'll choose something similar to the industry. Sometimes if we've got access to the company's CFO, they can tell us, well, we're always shooting for a 40-60 split debt to equity, or debt 40%, equity 60%. You might use that. But absent that, and in the case of our made-up company, Company A, we're going to re-lever the beta using an assumption of capital structure that is pretty similar to, I think it's the median of our comps. We'll see that when we get into our WACC analysis. Does everybody understand why we unlever and then re-lever beta? Very good. So that's the cost of equity. Cost of debt, typically a lot more straightforward. We're not doing a CAPM. Typically what we're doing is looking at each company's actual cost of debt. So we'll do this analysis for Kraft, we'll do it for Conagra, we'll do it for Kellogg, et cetera. We'll go to their debt footnote in the back of their most recent filing, 10K, 10Q. It will generally give us what their interest rates are and what the interest rate is on each respective piece of debt that the company has. And from there, it's really just a matter of calculating a weighted average of their debt. Before we do that, we need to make sure that we're taking into account a couple different categories of debt. Most companies don't have convertibles, but if they do, again, just like we did in our dilution exercise, in our treasury method exercise last week, if it's convertible debt and if it's in the money, we treat it as equity, we no longer treat it as debt. Same thing holds for this analysis. All right, so we're taking each company, what is their overall cost of debt? We'll do this for our subject company as well. All right, maybe the CFO can tell us it's 6%. We've got one line of credit outstanding at 6%. Our work is easy. Otherwise, we might need to estimate what the cost of debt might be by looking at comparable companies in the industry, making some judgment calls. But basically, the analysis is to take a weighted average of each company's individual cost of debt. So if a company has $500 million of 8.25% senior notes, $250 million of 9% notes, $300 million of 12.5% senior subordinated notes, and a tax rate of 40%, we take a weighted average of that, gives us 9.64 multiplied by 1 minus the tax rate to account for that tax shield, give us a weighted average cost of debt of 5.8% in this case.